Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, February 11th, just after the close. Special guest with me today, Dr. Leo Chen. Leo is the portfolio manager of our quant strategies that you often hear me discuss on the videos. So we're going to have a nice conversation with Leo on what some of the things he's seeing in the market, both currently and even 2 weeks ago when we had that deep volatility and drawdown. Quick notes on what we're seeing today. Right, we got hit with a double barrel. A lot of jawboning about higher rates. Bullard on the Fed, very outspoken about the Fed being behind and where they have to go. That's what took the air out of the balloon on Thursday. And then today, you get headlines about an imminent Putin move into Ukraine. We don't know if that's going to happen. You'll see a dozen experts on the news shows over the weekend. They don't know. Watch the market. Have levels that you want to get into names and sectors. On Tuesday, we did a special alert video called Semi-Signals. And it was just a video I did with an analyst from Dorsey Wright and Associates. We use them for some of our technical work on relative strength and trend. Just to go over some ideas and thoughts we were starting to see in a bottoming fashion in semiconductors. Remember, we've been very consistent for the last year that you want to be barbelled in your portfolios. You can have growth, but you need value. What worked this week? Energy, financials, metals and mining. Wonderful weeks. Many going out of 52-week highs. You need that anchor in your portfolios. Very necessary. If you have that anchor, you can be a little more aggressive in some of the other areas. So I'll continue to look and see if semis become part of the tactical trend strategy. Currently is not, but we did pull back to those Monday, Tuesday levels of this week that get interesting. Now, Dr. Leo has had a number of buy signals from his quant work over the last 2 weeks. And we call those clustered signals. When we can see 1, 2 signals, we get excited. We think there may be enough fear in the market that we can get a bounce. Yep. When we see 1, 2, 3, 4, 5, that gets very interesting. And that's what we've seen. As a matter of fact, we're speaking on Friday. At last night's close, you had another signal.
Correct.
So just to remind viewers about the quant strategies that Leo manages, and I won't get into all four, but the two primaries are called market vol for volatility and leveraged market volatility. One is a S&P buy-sell decision. The other is the same S&P buy-sell decision, but with leverage, a more aggressive strategy. And one of the things we've discussed also on these videos is how at Cumberland we think it's important that you diversify your overall portfolio by strategy, not just by security, but by strategy. That way, in different cycles, we can have different strategies working at their peak, because we all know that strategies can cycle in and out. So right now, Leo, in terms of some of the, in your quant work, some of the signals, not specific signals, but broad signals you're seeing in terms of fear and things of that nature. What can you share with us?
Sure, man. What we see this year is quite different from 2021, even the second half of 2020. Previously, we had one-day buy signal trades. Basically, we had a flash buy signal and stops there. However, in 2022, so far, our buy signal started about 2 weeks ago and continued for a week. It stopped at the end of January when the market got out of the 4,300 level on the S&P. Our latest one was this morning after the inflation data came out. However, this has been a prolonged buy range per our model analysis. What it says is that the market has been selling on fear. The peak fear level, according to our analysis, came around January 24th, 25th, and we saw extreme panic selling around that time in the market too. For example, the VIX climbed all the way up to 38 on the day of January 25th, and then fell back to 20 level pretty fast. Actually, during the intraday on Wednesday this week, the VIX touched below 20 briefly. But today, again, the VIX actually climbed back up to 30 level, briefly intraday. As you can see, the theme for the year is going to be volatility. What it says is that we will be trading frequently or more frequently than average, just because that we do not have a bearish view per our quant analysis. Therefore, we're likely to be dip buyers when the market's selling on fear again.
Right. And Leo, you are one of the original analysts that I have heard talk about regime change, right? We can talk about market cycles and so forth, but regime change means really a complete change in tenor or tone of a certain market. And it seems like this push higher in rates is really adding to the volatility on the equity side. And that may not subside anytime soon. So I'm with you, and I think we've been pretty consistent that we expect more what I call rips and dips this year. And we're going to want to be flexible on our portfolios. We're not going to mind carrying some cash at times. Right now in the U.S. portfolio and our quant portfolios, we are fully invested. In our tactical portfolio, we did a little more nibbling on Schwab. We had a 3% position coming into today, as you remember from last week. We added 2% this afternoon. Felt it was an attractive move. I want to stress that when you get a market that's now operating in a regime change, higher interest rates, you're going to have multiple shots. Be patient with the names that you want to own. Patience is going to be an ally of yours. And I often, when I'm talking to clients, refer to it as, bring it over to baseball. If you're a hitter and you're facing a good pitcher or a strong pitcher, a nasty pitcher, like this market is nasty, you want to try to work the count into your favor. If you can be a hitter hitting at 3 balls and 1 strike, your percentages, your batting average goes much higher than if you're swinging at 0-1, 0-2 pitches. The pitcher has control. I like to think of it that way. Trading does have many sports analogies to it. Why? Because we're all trading our own thoughts, our own ideas, our own opinions, and our own risk-reward parameter in a way against each other. We trade for our clients. Somebody that is trading their own opinion is taking our bid or offer against us or with us. So keep that in mind. Try to keep your capital intact and have levels you want to get involved in. Leo, appreciate it. We've got to get you back on soon. Everybody have a nice weekend. Don't forget to like, comment, and subscribe so you can get those updates when there's a midweek show. Have a great weekend. We'll speak to you next week.
Hi, it's John Mousseau, CEO and Director of Fixed Income at Cumberland Advisors. It is Friday afternoon, February 11th. It was a very topsy-turvy week in bonds due to basically 2 things. Inflation, number 1. CPI came in on Thursday. Market expectations were a 0.4 monthly number for January. It was 0.6. Had a big effect. Today's effect, which sent bond yields down after going up, was the fact that Russia is starting to gather troops near Ukraine, and the unknowns are that they might invade this weekend. That set everybody running to treasuries this week. But let's talk about inflation. Number 1, we expected to see higher inflation than expectations. Why? Easy. We had the Omicron virus in December and January. That dropped economic activity a lot, but what did it do? It really meant that you saw more in terms of ordering, crimping up supply chains, pushing up inflation. Plus you had the rent, owner's equivalent rent, which went into the CPI. We know rents are rising significantly. That had a big effect. What did the bond market action look like? Well, the 10-year bond started the week at a 191, was all the way to a 203 after the CPI number, and today was back down to a 193. So net, not much change. Same thing on the 30-year bond, which started at a 221, went all the way up to a 232 after the inflation print, back down to a 224 at the end of the day today. So when you see it, you say, boy, not much change on the week, but a lot of change in the middle of the week. Muni bond yields, cut this week. So the 10-year muni bond is about a 161, and the 30-year muni bond is about a 203. Both cheaper ratios to treasuries, mainly because of the treasury action today sending yields down. That's what drove those numbers. On the good news, with muni yields being elevated in the last month, you're starting to see small inflows after a number of weeks of outflows. So we still think that interest rates in general will trend higher. We still think that the rate of inflation will trend lower. You'll have a Fed which will start to raise short-term interest rates in March. We'll have a Fed's balance sheet which starts to level out in March as their tapering is done. And so without the Fed in the room, the 800-pound gorilla, we think that rates will probably start to rise even as inflation moderates and maybe gets to a long-term run rate of 3.5% to 4.5% later in the year. Next week, we're going to be watching PPI, very important, because that's been a very big driver on the producer side and has been at a much higher elevated level. So we will watch that. As you go into the weekend, we hope everybody enjoys the Super Bowl. One of the Moose maxims is that nobody should be alone on either Thanksgiving nor Super Bowl Sunday. So if you know somebody that's alone, make sure you invite them over. Please be safe with COVID out there. Practice safe Super Bowl. And I like the Bengals, who are a slight underdog. So enjoy the game. We'll see you next week.